you drawn to a focus on inflation and inflation risks after that core CPI number yesterday, or are you still worried about cracks in the labour market? How did you digest that data?
I think it kind of confirmed my prior view, which is always a bit dangerous in markets. As you know, I generally feel there's a lot of upside still in US front-end yields. I think the market is overly complacent about inflation, and I think we're far too worried about labour market. I do not think the initial claims yesterday particularly changed that. As you know, I think that's a very, very important indicator. It was partially why I wasn't too worried about the labour market. But of course, this was in a week that was disrupted by the hurricane. My overall view is that the US economy remains very strong, that yields will go higher as a result because we've priced in too many cuts in the curve, and that the stock market will be okay with that. It's not going to love it because it's already a very expensive stock market, but earnings are going to be perfectly fine. We know that from the macro level. The consumer has still been strong in this sector, so earnings should be good. We should see equities higher into year end, but it'll remain volatile because they're already so expensive.
How much higher? Are we in a holding pattern now with US stocks, or do they just continue to climb? If you've got yields moving north of 4% on a 10-year, if you've got pressure, maybe potentially from the Fed coming through with less cuts, how much higher can stocks really go with just earnings as a driver?
I think they can go a lot higher still because it's not just earnings. There's massive amount of liquidity in the system, and people have been cynical fighting this rally for a long period of time. So I think their tailwinds here are not just earnings, but we've also got the fact that people have just been way too negative on the economy. So you've got better growth, you've got better earnings. You're still going to have this fiscal tailwind that's not going to go away because of the US presidential election. And you still don't seem to have particularly expensive energy prices despite the disruption in the Middle East. So I think there are many tailwinds out there, and the only headwind is that the monetary policy won't be as easy as people thought. But that's because the economy is so strong. That's why monetary policy won't be as easy. So I think there are a lot of tailwinds for stocks still. I think they can still go an awful lot higher, but I think it'll be more volatile because they are expensive.
Mark, let's talk about your other expertise, and that's the FX story. I want to see what is moving euro dollar here. We're at a 109.37 read on euro dollar at the moment. Does the budget conversation in Europe even matter, or is this all about the U.S. election when it comes to that currency pair?
I think there are two aspects. I mean, normally dollar's the bigger driver of euro dollar out there, but I think there's just real deep negativity around Europe. You could say that for most of the last 16, 17 years, but I feel it's particularly intensifying again. You know, people are realizing the US economy is doing well. China's stimulating, so maybe Chinese economy will do better. A lot of the rest of the world was doing okay already, but European growth continues to get worse and worse. And this is the sector where interest rates might still have to be aggressive, or even more aggressive than we're priced, even as we're going to price it some of the rate cuts in the US. So I think that negativity in Europe's going to remain really strong. I see more downs in euro dollar into the US election. Don't know after that.